Yo, what's up, guys? It's your boy Looney, and today I want to break down some of the most popular investing strategies out there. There's value investing, growth investing, and dividend investing. Each one has its pros and cons, and depending on your goals, one actually might fit better than the other. But before we dive in, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month with one-on-one coaching, trade callouts, my full option selling course, giveaways, and more. All the links are in the description. All right, let's get into it. So strategy one is value investing. And this is where you look for companies that are trading below their intrinsic value. And this is sort of the Warren Buffett style, where you're buying companies that are undervalued today with the expectation that the market will eventually recognize their worth. So the pro with this is you're buying strong businesses at a discount, which could actually protect you on the downside. Now, the con to this is sometimes those cheap stocks stay cheap for a long time, and you need patience. So we could look at one like Amazon. Amazon hasn't seen that growth that the other big companies have shown. Past 5 years, only at 40%. It's valued at $220. And this is one where it might take a little bit to actually get that realized value, but it is a good opportunity in the sense that long-term, this company will be here. And on a long-term basis, it should be a higher valued stock price. And this company will stay here for years to come. So this one is definitely a staple. Let's actually look at one that is the most recent example, and that's UNH. So this is one that was seeing declining growth in the past year. You can see in the past year, it is down 39%, and due to various reasons, but most recently, it actually started to climb. It's the past 3 months, it's up 17%. And part of the reason was actually because of Warren Buffett. He disclosed that his company was actually invested into this company and they bought shares of it. And this is one where many had to stay patient, and it still is at a point where you kind of have to still wait it out, because although you might be up in the past 3 months, if you did buy back here, you still have to have that recover, because we go back here, we can see that massive drop, and it still hasn't fully recovered from that drop. So this is one where there is that opportunity, and long term, that growth or that value should actually be recognized in the long-term basis. Now, value investing, I don't do too much of it other than Amazon. I'm not actively invested into Amazon. I just simply hold it, and perhaps I'll sell it one day. Maybe I'll start investing a little bit more. But as of now, I just simply hold. And you can see here on the long-term basis, a lot of analysts have it as a buy situation. And I'm actually curious to see what the value is. So the fair value is actually at 245, or at least that's what it has on here, the research report as of yesterday. So you can see here that this is considered, I'd say, slightly undervalued. I wouldn't say it's super undervalued, but it is a good opportunity in a strong company. Now, number two, and this is kind of what I do mostly, and that's growth investing. So this is about finding companies that are expanding fast. So think back to like Tesla or NVIDIA, or even some speculative plays like I have, like SoFi or Riot. The goal with this strategy is capital appreciation. So there's big upside if the company keeps growing revenue and market share. So the pros to this is you could get those explosive returns if you're right. The con is higher volatility. So these stocks can actually swing 20, 30, even 50% in a year. And if you buy at the wrong time, you might be underwater for a while. So let's look at like Riot, because this is a crypto mining company. And if you bought, actually, now that I'm looking at it, it has grown so much that it probably, well, I guess if you go back to 5 years. So if you bought back in 2021, you would still be negative 49%. And you can see here how much it decreased. It decreased by 80%, even 90% at some point, depending on where you bought it. And this is where it is super volatile. This is a super volatile stock. And should you be buying at these prices? I'm not sure. There's definitely room for this company to grow further. We could definitely see this stock increasing or doubling at a very fast pace, but at the same time, you shouldn't be buying a lot right now. If I were to start my position in Riot, I would buy very small amounts, maybe even sell puts or dollar cost average. But I bought this back when it was 926, back when I felt that there was a lot more upside than downside potential. And you can see I'm up 109% from that decision. And another example we could look at, Oscar Health, I guess. This one had a growth potential. A lot of analysts were saying it was a sell, and it's in the same space as UNH. So I saw opportunity with that, and I'm up 52%. And then SoFi, one that is actually struggling recently, but I don't mind the struggle because I was able to acquire it at a pretty good price at that $11.29. I'm up 124%. And this one's actually a good example too. Like it is very volatile. So it goes up 100% and then comes crashing down at 50% or even 77%, depending on where you're buying. So buying at like high levels is very risky. It can actually still work, but at the same time, buying heavy at high valued prices is a dangerous thing to do because we can see how volatile this stock is. But if you can weather the storm and you have the cash available and you can dollar cost average, which I like to do, because I'm not buying once and then that's it. If Riot keeps decreasing, it goes under my $9, then I'll buy more. And that is my strategy with growth investing, is buying it for cheap and then waiting for that explosive action returns. And the last one we're going to get into, and this one, I don't really actively do it, but I have it in my portfolio, and that is dividend investing. So this strategy focuses on companies that pay constant dividends or consistent dividends. So we could look at like Coca-Cola, Johnson & Johnson, or some ETFs. And these pay you cash just for holding shares, which you could actually reinvest or use for income. So the pro with this is steady cash flow and less volatility than growth stocks. The con to this is dividends alone won't usually make you rich. You might underperform high growth names in a bull market. And I have SPY and VAO. These ones I used to invest in, but I'm just simply holding. Maybe I'll sell. But I like having these as a benchmark to see what the returns would be if I just simply put it into the VOO or SPY. And then there's some individual companies that pay. I believe Google is one of those. I don't think it pays that much. It's not really considered a dividend stock, but it does pay a dividend yield of 0.33%. So yes, very slow growth and it's safe. So that is the pro to it. But the con is when you're in a bull market, something like this is getting outperformed by some growth names. Even ASTS is one that has been absolutely shooting up in the past year, 183%. It only takes up around 1% of my portfolio, and I'm still up pretty significantly, up $200. So dividends, safe, but also I would consider you're missing out on the opportunity in a bull market. So the key is knowing your goals. If you want income in retirement, dividend investing is definitely powerful. If you're young and want big growth, lean toward more growth and value. But if you want that safety, ETFs and value stocks can help cushion that volatility. At the end of the day, the best strategy is the one you could stick with through red days and market corrections. Consistency beats chasing hype every single time. Until next time, peace.